There are different ways of making money with your investments so that at some point you can completely live just off your wealth. And dividends are not the only ones. I spent the last 10 years learning about investing and also investing my own money so that at some point I can become financially free. Actually, if I were to move to a low-cost area, I could already do that. I would be financially independent. But living frugal is not my thing at all. That's why I'm continuing on this journey. And I remember when I started with all of this, I always wondered how people actually live off their wealth, how this concretely looks. So if you're wondering the same thing, why don't I show you what I discovered? And I'll also tell you what I personally think are the pros and cons of the different ways of making money off your investments. Now, a company can decide if they want to share their profits with their shareholders, and they can do that once a year or several times a year. And when they do that, you as a shareholder get paid a dividend. That's what this profit sharing is called. So number one, and you probably knew that already, one way to live off your investments is through dividend income. And I think the pro is it's one of the simplest forms of passive income because you buy the stocks and then you get paid for having the stocks. And I think one of the challenges of becoming rich or becoming financially independent or financially free or whatever you want to call it is that you want to build this machine, this like money-making machine, or in another video I call it the goose that lays the golden eggs for you without additional work for you, so that it keeps paying you without you having to invest any further. And at the same time you want to keep this machine going or keeping the goose alive. And with many other investments, it's not always easy to keep this machine that produces money for you and the money that you actually then live from, to keep it separated. But with dividend income, it actually is, because you buy the stock and you keep the stock and you get paid the dividend. So the two are very well separated. Now, the cons of this dividend income is that you actually need a lot of money, especially to finance an opulent lifestyle, because per share you own, you get usually paid a few cents. So you need a lot of shares to actually also get paid a lot. And also because not every company pays dividend, you're kind of like restricted with the choice of the companies you buy. There is also a market risk because it's possible that the company goes bankrupt and then you don't get paid anymore. Or it can be that the company decides to not pay out the dividends, or at least not that much, so that they can invest it back in their business. So that is probably something to consider, but of course the market risk is there with every other investment as well. And for me personally, there was another con, and that is that you actively have to pay out the dividends if you want to live off it. I actually am invested in some dividend stocks, a quite specific high yield dividend strategy that I learned a few years ago. If you want to learn more about that, you can let me know in the comments. But okay, this might even sound a little bit stupid, but my investment account is not directly connected with my checking account. So when I get paid the dividend, it lands directly in my investment account, and I would actually have to actively look up how much it was and then make the transfer to my checking account. And ideally, I'd also have to hold back the taxes. And to be honest, at the moment, it's just too much friction for me, and I end up just leaving it there in the investment account. Another way of living from investments is when the company grows in value, but you bought their stocks when they were less valuable, and then you have the capital gain. And that is the goal of every investor, to buy low and to sell high. Now, a capital gain is not just a thing with stocks and funds, but also for other assets, but let me stick to stocks and funds first. Now, my investment strategy in general is a buy and hold strategy, so that I hold investments for a very long time. And for the most part of those investments, I choose an accumulating strategy. And the pro there is that as long as you stay invested, your money keeps compounding. And because of the exponential growth, you can have a huge profit after a certain period of time. And that's what I personally aim for right now, to focus on my income and to feed this goose or this money-making machine and let it grow as big as possible. Now, the con is of this strategy that in order to live off of that, you actually have to sell parts of it. And that for me is a con, because selling something is actually psychologically difficult. I think it's a mixture of loss aversion, so the fear of losing out on potential gains, the optimism bias when you think it's always going to keep growing, and also the endowment effect where we overvalue things that we already own and then tend to hold on to them longer than it's reasonable. And it's a con because here we do have the challenge that we don't have a separation of the money-making machine earning and the actual income. So it's all just one bulk of wealth. And that is where the 4% rule comes in. Now the 4% rule states that you can take 4% off of your portfolio out every year without risking the principal, so without risking our money-making machine. Now these 4% are rather a guideline. I think there are people who take more out. I think there are also people who take less out. I think to be on the safe side, the less you have to take out, the better. But of course that also depends on your age and your net worth and your earning capacity and your costs and all that stuff. Now I said that I would come back to a capital gain in other assets as well. And of course it doesn't have to be companies. It can also be commodities that you buy for a lower price and then try to sell for a higher price. It can be currencies, and crypto is a part of that. And for me it's actually a bit weird because I have been investing before crypto actually became a thing. But it seems like many people understood this buying low and selling high thing with crypto because it happened so fast, and they hear all those stories of those crypto millionaires, which for me is wild because it's actually the same principle in the stock market. But those people are afraid of investing into stocks or into funds, and I think they're not enough afraid of getting into crypto. But yeah, that's a story for another time. And another asset where this capital gain works as well is real estate. That's when you buy a property either at a certain time and then you hold it for a long time and hope it will gain in value, or you buy it in a certain condition and then you renovate it and then you flip it for a higher price short term. Then there you have also a capital gain. And that brings us to the third way of an income, because when you buy real estate but you don't flip it, you can also hold it for a longer time and then live off the rentals. And this, by the way, doesn't even have to be real estate. You can also rent out your car or smaller items like gear. I think the pro of real estate or rental income in general is that it's also one of the classic ways of making passive income, because you buy the property or the other thing that you're planning to rent out and then you get paid for people using it. And there we also have this nice separation of the money-making machine and the income. The con for me personally, and this is also the reason why I haven't invested in real estate yet, except for a REIT, a real estate investment trust, that I actually bought over the stock exchange, so that's not really the same thing, although both are ways to invest in real estate. But the thing for me with an actual property is it's time consuming, it's money consuming, and I also think the return is rather mediocre. Let's start with time. Now I am an investor, and of course I have thought about investing in real estate, but the number one hurdle for me is that it takes up so much time. Because first I would have to research how to actually invest in property. I think that would actually be the fun part. But then on top of that comes the research for the actual properties, and then making the appointments with the sellers, then going there, having a look, maybe hire people to get a second opinion because I'm not a specialist in this field, and then also doing all the calculations, getting in contact with the banks, all that stuff. And at the moment for me, I'd rather invest all that time into my side hustle instead and be able to turn it into a main hustle eventually. So yeah, that's why I decided to go with the REIT instead, because it's just much faster. Another thing is that I cannot do it alone. I would need to get in contact with the seller. I would need to get in contact with the bank, to negotiate the payment or the mortgage. At some point I would have to get in contact with contractors for renovations for the building. At least in Germany, it's also advisable to have a lawyer in your boat. So there's just so many other parties involved, and it's not just me sitting on the sofa and hitting the buy button in my trading app. So yeah, for me that was definitely another point. A third one is the money, because buying a property is a big chunk of money right away, and it's not that you can start small with small amounts like when you start investing into funds. And I think this has two consequences. One of that is that your money then is in this one thing, in one basket if you will, and in your whole portfolio having a lot of money in one thing always has a level of risk. Then additionally, if you don't have the money yet, you have to take on a loan, and that is another level of risk. And I know there is this argument that you don't pay for the loan yourself, but your tenants do. So when the property is cash flow covered, the risk, however, is still mine, because it's my name at the bank in the mortgage. And if the tenants don't pay or don't want to pay as much, I have to pay. And that also leads us to another point, which is the return. Now, I found numbers from the US where the return for real estate averages an 8% per year. In Germany, it's rather between 3 and 4% per year. And that, to be honest, is not that convincing to me, especially considering all the other factors we just talked about. But I do feel like there are these two camps of investors, like the ones who are really into real estate and the other ones who are rather into the stock market. So yeah, of course, at the end of the day, the decision is still yours. All right, now we covered stocks and funds and also real estate. Now let's move on to one of the oldest ways of passive income, and that is when you become a lender. So when you lend someone money and then you get paid interest on that money, so you have an interest income. One way to earn that interest income is through a savings account or a money market account, because you put your money there and the bank might use this money otherwise while it's parked there, and for that you get paid an interest. So the bank basically rewards you with a small interest for putting your money there. Bonds are also a type of interest income because you lend your money to the state or a company, or you can also lend your money to private people, either by giving out a personal loan or by using a peer-to-peer lending platform. And then the platform gives out the money to borrowers. That's why those P2P lending platforms have relatively high returns, but at the same time also a high risk, because you can't actually be sure that the people can pay back. So there are rather big differences between those different forms of interest income. So the pro with bonds is that it's considered a relatively safe investment, especially when you choose government bonds from Western countries. The pro of those P2P lending platforms is that you can have a decent return. But then of course the con is that you have also a quite high risk. And regarding the separation of our money-making machine and the income, you actually have a nice separation. It's just that most of the time loans have an expire date, and then you should just make sure that when it expires, you reinvest that money into another form of investment, maybe the next loan. And there is another way of making money with investments that I want to mention here, and that is when you own parts of a business other than stocks. This can be either through venture capital, when you invest in companies that are still very young or small or whatever you want to call it, or if you invest in private equity. Now, in both cases, you also get shares of the company, but they are not publicly traded shares yet. And then you obviously can benefit from the growth of the company. Now, as a private investor, it usually takes huge amounts of money to invest in this. It's also high-risk investments where you have to be prepared that between 80 and 90% of the companies are going to fail, especially when it comes to venture capital. And also for those kind of investments, it's not that easy to access them. The people who I know who do that are either multimillionaires or they work in the field, or both. I don't have investments like that yet, but I can keep you posted if you want. Now that you know how to make money from investments and you want to take action, I'll link my beginner's guide to investing here. I hope you got some value out of this. Thank you for watching this far and for spending your precious time with me. And I'll see you in the next video. Bye bye.